future. We're talking real money.
Welcome to another hour or so, depending on how you're listening, of Talking Real Money. I'm Don McDonald, Tom Cock over there. You're there. We're glad you're there. And we encourage you to call us at 855-935-8255, 855-935-TALK, as a couple of people already have, and we'll get to them after our next break. But first, we want to discuss something that a lot of people have. You probably, if you work for a major employer and even some minor ones, you very likely have some sort of a retirement plan at work, a 401k or a 403b. They're very, very similar in their structure. But are they doing, these 401k plans in which you're investing, are they doing all the things for your future that they can be, Tom?
Well, and many of them are, there isn't one right answer, as you know, to that. There are many that are good, there are many not so good. But in a general sense, if you're saving something or investing something, that is, everybody should be doing that if you have an employer-sponsored plan, no doubt. But here's what we see. Oftentimes people put some money in and then they don't make money. I mean, look at the last couple of years, right? Stocks really haven't made much. Bonds have lost money. Mm-hmm. So what happens is people then say, this doesn't work. I got to either quit doing it or I got to move it. I got to move it from here to there. You know, and this is the problem. We get itchy fingers about these things, and that is problematic. So then the question always we get is, okay, well, what would be a better alternative for most people? And this goes against what I said 20 plus years ago when I was on television, because I used to say, don't do this. But today I think it's the right thing. And that is a target date fund, because it's adjusted for you depending on where you are age-wise in your life. It's generally fairly diversified, not as much as we'd like. Okay, that's fine. And the cost generally is okay. It's not great. Not every target date fund. Don't just buy one and think you're okay, because many are expensive. But in a general sense, it's a better selection for most people.
They're a compromise kind of vehicle. They really are not the best of any worlds, but they're very adequate. And what they do, and this is the strength of them, and I'm with you. Years ago, I went, it doesn't take into account a lot of things like your inclination, your risk tolerance. And for a lot of people, a target date fund is not appropriate. You should build your own portfolio if you have the discipline to do the things that are necessary, and that is to sell your winners and buy your losers.
Which is a very hard thing to do. People don't like to do it. But here's the other thing, we just read this, that I find fascinating. In 2022, only 2% of target date fund investors traded their holdings. So people that buy into a target, and very few people that put their money in target date funds sold that fund to buy something else, to say, oh, that didn't work, I got to move it.
Because you've already got everything.
Bingo. So, and so it keeps your fingers off the trigger a little bit, as I just said a minute ago, which is a big problem, because right now we're still seeing people either moving from bonds to cash, bonds to stocks, bonds to anything else, because they haven't. I saw a guy just called me about a real return portfolio instead, which is some real estate, some other junk in there, because the bonds haven't made money. Tom, I'm not making money there. No, you haven't made money there. You don't know what you're making, because the future is going to look different than the past.
Well, and the other thing is that 401ks and 403bs often have a lot of bad managers behind the scenes, taking advantage of your emotions and getting you to make these moves into things that make them money, but not you necessarily, or not as much for you. The nice thing about a target date fund in a 401k or 403b is that it gets kind of the bulk of the portfolio in a reasonable position, allowing you to, as you learn more, as you make more money, and you've already funded all your retirement plans. Well, outside of a retirement plan, then you can add that small cap value. Then you can add some more international or emerging markets or whatever it might be in your taxable accounts using ETFs, which have a modicum of tax advantage to them.
And listen to these couple more numbers around this. It's fascinating. Target date investors over the last decade, according to Morningstar, made almost 6.5% a year, losing only 0.5% of the return. Those who own their own funds gave up almost 2% of the return because they moved the money around. Tragic.
That kills people. And it's it's a good foundation for a plan. 855-935-TALK. We'll get to the calls in a moment.
Tom and Don are talking real money.
Do you suffer from hodgepodgeitis? I'm Don McDonald, and hodgepodgeitis is a disease of your investment portfolio whose symptoms include lots of stocks, loads of random loaded mutual funds, and maybe an annuity or two. Most who suffer from hodgepodgeitis dread opening their quarterly portfolio statements. They feel lost and confused. Investing seems overwhelming and the financial future uncertain. If you believe you suffer from hodgepodgeitis, see a 100% fiduciary investment advisor immediately. A proper diagnosis is the first step to creating a portfolio with a purpose based on a personal plan. Start on the road to recovery now by scheduling a free meeting with an Appella advisor at TalkingRealMoney.com. There is no cost, obligation, or high-pressure sales pitch. Take the first step at TalkingRealMoney.com or call 800-386-3004. Hodgepodgeitis is not a real disease, but treating it has been shown to improve mood, reduce fear, and even lead to a brighter financial future. Results may vary.
Your guides to a really great financial future. Tom and Don are talking real money.
And we want so badly to help you stop doing some of the things that we know you do with your money. We want you to call us before you do something, but most of the time you call us kind of after. But we can still do some things then. Just call us at 855-935-TALK, 855-935-8255. And Brad, you're up. Thanks for waiting and welcome to the show.
Hey, Brad.
Oh, thank you. Hello. Thanks for taking my call. Hopefully I'll make it simple. I'll give you the basic facts, then you can ask me questions if you want. I'm 75. I've got my own home, no debt, so a little bit more rental real estate. My income is basically earnings on investments or Social Security. I currently have $100,000 in Russell in their balanced growth fund, which I put away for more long-term money. But I've got about $550,000 basically in money market, and I'm considering buying a $500,000 jumbo CD for like $485 for 6 months or $495 per year. What should I do before I made that move?
Can I ask a question?
Sure,
why are you thinking about that? What's your reasoning behind getting a short-term CD for the vast majority of your money?
I'm not sure. I may be building a new house and need part of that money for it, so I want it somewhat liquid, but I really don't need it to live on.
Yeah, I think that's a good answer. I mean, if it is truly money that's going to be needed short-term, fine.
Might be, yeah.
Yeah. Longer than that, no, I wouldn't put all my money in a CD for a 6-month CD because it's going to make a little money for a while, and then you're going to be right back out figuring out what to do with it next. I would try to work hard on saying, here's how much money at the max I'm going to spend on the new home, etc. Then the rest of it would be balanced between stocks and bonds in some way to provide future growth for your life and then whatever the money's going to do after you're gone. We're not sending you off anywhere, but that would be how I'd look at it.
Yeah, and the thing is, Brad, you and everybody, we desperately, all of us, need to start, instead of starting with where are we going to put the money, which is where all of us start.
Yep.
Most of us, not me anymore. Used to. Where am I going to put the money? Instead of doing that, what you need to figure out is, what do I want this money to do? How much of it do I need to use to generate income? How much of it do I need to grow to replace potentially some of the assets as I draw them down? How much do I need for immediate liquidity? And then you build your portfolio in pieces based on that. The liquidity part is the money that you need for, 1, emergencies, which isn't $500,000, or 2, to buy a house. Other than that, now you should start having a plan for the assets, and the plan isn't just the Russell balanced growth in
which I don't.
fund.
Is that a balance between stocks and bonds, or a balance between growth stocks and a different type of stocks? Because when you say
I think
balanced,
it's a stock and bond, but I'm going to look it up
because I'm not familiar with that fund directly. We certainly are with Russell, trustworthy organization, but they have actively managed portfolios there as well.
Yeah, I'm still looking for balanced growth. Is the name?
Brad, you still with us?
Percent fixed income, yeah. Yes, I am. Balanced.
Okay.
Balanced.
Yeah, so that is between stocks and bonds.
I can't find it.
So you started to give the percentages there, and we interrupted you. What is it? What did you say?
Okay. They say it's equity 56% between large cap, small cap, and international, and then 39% of fixed income, mostly tax exempt bonds, et cetera, and then 5% in real estate.
Yeah, so that's a balanced.
That's a pretty
fund.
well diversified.
Yeah, that's not bad. So that the idea there is you're getting some part of the market return, you're getting some stability with the fixed income. Not sure really why they throw real estate into a taxable portfolio, but that I guess at 5% that's not a huge deal. So that sounds okay.
Yeah.
Did you know what the expense ratio is on that fund?
I'm looking for it.
If I remember right, it was like 0.5% or 1%. I don't know right off the bat. I saw it at one time, but I don't think it.
Wait a minute, balanced growth. It says it's Canadian.
It's the one below that. It's the one right below that. There's balance, and then there's balanced growth above that. So I'm in the one that's balanced growth has 68% equity, and I'm in the balanced one, which has 56%.
Okay, I am just having a heck of a time.
Usually Don's pretty good at finding this stuff,
fund.
but that's okay. So yeah, I mean, again, to have a balance, that's what I think you should do with all the money that you're, and not necessarily that fund, but all the money that is not going to be used for your real estate project to go in something like that. I think that does make sense.
Yeah, we agree.
Okay. Yeah, that makes sense to me. Okay, thank you so much.
Thanks, Brad. Take care.
Bye.
The only one I can find is Canadian.
Yeah, which is it sold on a U.S. exchange?
No, it's not. It's only sold in Canada, which is really weird, but I can't find it, which is unusual because I can usually find it.
You're really pretty good at finding stuff on the interweb, I'll say that. On. So, yeah.
All right, 855-935-TALK is our phone number. Frank is up next. Hey, Frank, welcome to our program.
Hello, fellas. Hello, St. Tom. I have a suggestion.
He listens.
And a question.
Yeah,
all right.
I do. And the suggestion has to do with listeners of the podcast. I hear this nonsense about keeping it to 20, 25 minutes for commuters.
Yep.
The playback speed can be adjusted.
That's
from
true.
1.0 to 1.25.
Okay, that was just a lousy mistake, excuse on our part because we don't want to talk more than 20 minutes.
No, I'm okay with you speeding Don's voice up, but please don't speed my voice up if you don't mind. I'm okay with his, not mine.
I've heard it. It doesn't sound good.
No, it's not. No, I appreciate it. Go ahead.
All right. What else?
And the other is a question. One of the things I like about this show is that you're rather candid in your comments about other folks in the industry. And while he's no longer active in the industry, I'm curious what your thoughts are of Bob Brinker. I listened to him starting in the 80s.
Yeah.
He got me into no-load index funds. Mm-hmm. I know he pushed those hard, but curiously, he also had a publication, probably paper, and then went to internet.
Bob Brinker's Market Timer.
Yeah,
Yep.
Right. Yeah, we're well aware of that.
Yeah.
He had a horrendous call. He had a horrendous call to put it all in technology in about 2000. By the way, just if I remember right, 2000, 2001, right before it went down 70%. But, so you want to know what we think of Bob? I don't like those people that do that, and I never liked the market timer thing because I don't believe in market timing.
And he seemed everything. Bob Brinker always seemed like a contradiction. Because he would, as you said, he would say, do some index investing, but, subscribe to my market timing newsletter. He made a lot of money off that, but got to tell you, the reviews were not good. His performance was terrible, and for when people tracked it back years ago.
Long time.
Yeah, it's been a long time.
I think he was one of those guys you could listen to for a long time because he was extremely knowledgeable about markets. He could go on for an hour and talk about all the stuff that was going on, sort of macroeconomics, that sort of thing. Wonderful. But this is the problem in this business. When you boil it down to what does that mean to me as an investor, other than giving people index funds, which I think is really good advice, people like Bob get cornered into giving other advice that oftentimes is not very good.
People try to corner us into doing that.
Yeah.
By the way, Bob Brinker shut down the Market Timer newsletter in June of 2023.
Wow, just done.
At 82 years old.
Good for him. All right.
All right. Thanks for being there. Give us a call, 855-935-TALK.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
855-935-TALK is our number, 855-935-8255. I didn't realize Bob Brinker was that much older than me because we were on the radio at the same time.
I know. Yeah, I liked his show. I enjoyed it. He had very
we run a lot of the same stations.
Mm-hmm. But it makes sense, by the way. I want to thank Frank for asking us to speak longer than we do because generally in my life, in most parts, they ask me to speak less than I do. So I appreciate that.
Yeah, but bear in mind, that's just one man's opinion.
Oh, that kind of hurts. Then there's the other 8,000 people downloading the podcast.
Whom we have not heard from yet, but we have an opportunity for someone else to chime in, and that's Cindy. Cindy, welcome to Talking Real Money.
Longer or shorter, Cindy? What do you say?
I've got a notepad here that I just flipped over. I'm sitting in my car, so maybe we better go with the long talking.
Okay.
But hi, and thanks for taking my call. My husband and I are both 67, so I am unemployed. I'm a housewife, and he is getting ready to retire. He will get no retirement from work. We have about $1.3 million in assets. Mostly with Vanguard. We do not own a home. We have lots of Roth IRAs, and we have 175 in traditionals. We have 180 in a 3-year CD. We got 40 in index bonds. So of that 1.3 million, I should also tell you we have about 230 invested in mutual funds, joint mutual funds, that we are going to have tax liability on. We put 75K in Vanguard in 2011, and it's done extremely well. It's up to about 230 right now. There's 4 different funds. So our main question is, and my husband's been working on this, the order of what order of withdrawal starting next year, since we don't want to take Social Security till we're 70.
Nice.
Very wise.
Awesome. That's good.
Very wise. The order is very simple. It really is simple. You want to let the tax-advantaged investments ride for as long as possible. You want to just get the taxable stuff out of the way.
And the IRA and the Roth. Yeah,
IRA and Roth are waiting. The taxable accounts are where you're going to draw from for the first several years. Then the next one will be the regular IRA or a regular 401k. But I assume in your case it's a regular IRA. You don't have a 401k. That would be the next place. The Roth is last.
Okay.
Because it's tax-free.
That's what he's thinking. Yeah, that's what he's thinking. Now, I've contacted Vanguard a couple times looking at these long-term capital gains, and if we don't live a lavish lifestyle, we don't require a lot of money to live. Mm-hmm. We're pretty low-key. So I was asking them about these long-term gains on these 4 funds that are just mutual funds, and they showed me how to look it up, and I was a little concerned because, like, one account we put 25K in, it's Windsor, and now it says the cost is like $39,000, and I asked the guy, why is it saying my total cost is $39,000?
Reinvesting?
Yeah.
No, it's from reinvesting along the way.
Okay. All right.
Along the way, whenever they declare a dividend or a capital gain distribution, those monies almost always go back into the fund at a new price, raising your cost basis.
Right.
So that's because of
right.
Now, I have a question for you, though. What do you expect your income, your taxable income will be your first year in retirement, or what does it need to be?
Okay, so that's part of the question. So we're thinking we need about $7,500 a month to survive.
Okay. Yeah.
Pay our rent and whatever, unless we want to get lavish and take an exotic trip or something. So he was going to start withdrawing his mind is, we'll do those mutual funds, those joint mutual funds. And we discovered that your taxable income, as long as it's...
Hang on a minute. I know where you're going with this, and it's going to take longer than we have. So we need to take this break because it's an on-time exact break. And then we'll come back and talk more about your capital gain and how low it might be.
Tom and Don are talking real money. Reality radio for a really great future. We're talking real money.
We're chatting with Cindy about their preparations for retirement and trying to figure out from where to take what to give them the income they need. The income they need is probably going to be about $7,500 a month, which is $90,000 per year.
Yep.
For a married couple. That's a very good number for you because it means you're not going to have to worry about capital gains.
Please explain more.
Yeah, that's what we were thinking. But that $89K that I read online for if your income's $89K and some change or below, you don't pay long-term capital gains. But then you get to add back in the married filing jointly deduction of $27,700, right?
Yeah. So the reality is, because that's going to be all of your income, those capital gains are going to be all of your income. You're really not going to, your tax situation is going to be pretty good.
We're talking about the wrong things here. Number one, first of all, to take out $7,500 a month out of I believe you said portfolio of $1.3 million. Did I hear that correctly?
Yeah.
Okay. That is a very high withdrawal rate. So at 4%, it would be $52,000. So that's one thing to consider. Number two, while we both applauded the fact that you're waiting on Social Security until age 70, without delving into your numbers more carefully, which I think you should have a professional do, I couldn't really tell you that that's a great decision because it may turn out, for example, that the computer program says, you really ought to take it at 67, 68, 69, because you're going to be drawing a lot of money from the portfolio. Remember, early withdrawals and a potential bear market could be very harmful to your long-term financial health. So that brings me to number three. Really, at this point in your life, it is going to be worth it for you to pay a professional to look over your plan, to perhaps even write you a plan, to say, here are the things really to think about, because this is so important at such a moment in your life to get someone who does this every day, who is 100% fee-only fiduciary and does it right. That's what you really should be looking at. And that sounds like a promotion, but we're not the only ones. We say this regularly. But you really ought to have somebody who really knows this well, rather than, and no offense to Tom and Don, is going to give you, real quick advice over the radio, because here it's not the detail that you really need at such an important moment in your life. Really, I got to say.
However, after Tom's speech, I got to tell you, if it's just for 3 years that you're drawing this $90,000 a year out, if it's just for 3 years, because you're going to wait on Social Security, it's going to kick way up.
It's going to be higher. There's no doubt.
Right. So you'll be able to take a lot less out of your portfolio going forward.
But I would still have somebody else look at your situation.
I agree with that part. But you just were long-winded. I know why you're long-winded. You're just doing it because people told you to be longer-winded.
He said, go on.
Just because Frank tells you to, Frank told you to jump off a bridge? Never mind.
Probably.
Go ahead, Cindy.
No, my husband has done retirement calculations online, but we do agree with you that we need to have a professional look at it. And I've already looked you guys up online to get in contact with one of your people. So this is something that your people do, and we just pay like an hourly rate or
actually. Let me tell you something, Cindy. You can call them or go online and set up an appointment, and we'll give you up to an hour for nothing. Free. We're not going to even charge you.
Yeah, and it may be that we just say,
it may be that an hour does it, because you guys are, you've got a handle on it. It sounds like you just need a little more advice. You may need long-term advice. We don't know until we look at it and discuss it with you, but that's why we do it for free, because it's like, I don't want to pay somebody unless I'm going to use them. So don't pay us yet. Okay?
Okay, because in 2020 we called a different, I'm not going to mention their name, but we didn't like the gentleman, and he just wanted us to sign up, and he wanted to take charge of all
We'll
of our
never do that to
and I
you.
was like,
We have never done that to a single soul in 14 years now, Tom?
Well, plus you throw in Merriman, it's more than that. So
Yeah, we have never, ever, ever pushed somebody to become a client, and we never will. Because why?
great. Now, one thing I should tell you is our Social Security is not going to be real high. I think it's going to be at 70. It's estimated combined of $50K a year because we have.
wait. 50 of 90 that's a 50,000 of the 90,000 need. Sounds like a pretty substantial part to me.
Actually.
Yeah,
Basically,
that's not
just
bad.
rough math tells me that with a 4% withdrawal from your portfolio, even after taking out
Good point,
the
Don. I see where
90,000 a
you're going.
year, if
Yeah,
nothing
right.
changes, that 50,000, you're only
Good
going to have
point.
to take another 40,000 out to keep the same income stream.
There you go. And then you can add in a few of those extra goodies you mentioned.
Yep.
The trip, whatever else it is.
Yep.
Yeah.
Yep. You need an advisor, though, probably, because you're going to want to have somebody to tell you down the road, no, don't do that.
Plug
You need
this
the money
in,
for the
plug that
trip. And yeah, right. This is not the year for you to take the trip. Maybe next year. 855-935-TALK. Thanks so much, Cindy. We appreciate your call.
Yeah, and that's
we
kind of you.
appreciate
Yeah,
all
and
of
we
you.
appreciate you reaching out to us. So, but
Yeah.
here's the thing about that. I think people still have the wrong notion. Number one, when you call somebody, you're going to get sold something.
Oh, yes, you are most of the time.
It scares me because then here, what happens is people say, "I'll figure it out on my own." And
Because they're
oftentimes
afraid.
They are, and oftentimes they make a mistake then as a result of that. Because no, I got to figure it out. Well. Yeah, you're right, Don. I mean, they should be scared, be very scared in many ways. But if you find the right firm, and the right firms are out there, you got to dig a little harder.
But
it's harder to find them.
On the radio or on podcasts, the right firms. I bet you in the podcast universe, and I've listened to a number of podcasts,
There's
in the
only
podcast
several
universe.
tens of thousands or something.
Yeah, but I bet I could only find tens of firms with whom I would work. I
Probably
know
true.
on the radio in Seattle that the number would be one.
I'd have
One.
to think it through, but I think you're
No,
right.
think
on
it
the
through.
radio.
One.
Yeah, right. Yeah,
the rest
good
of
point,
them,
yeah.
the rest of them are pushing garbage products, and they're salespeople. They're not.
They have an agenda, and
Yeah.
it's not yours.
And
that's
it's
the
not
problem.
yours.
Yeah,
Yeah.
that's a problem. So,
It's all about selling you an indexed annuity or something, which they still do with
I know.
impunity.
even though your
Although-
bonds now are paying 4% again. I mean, how do you get away with that? Because they make them a big commission? Could that
Yeah.
be it?
There are huge commissions, huge commissions. As a matter of fact, we've got a call coming up after the break. If we don't get another one, I've got one that somebody called in. Oh wait, no, we do have somebody. Never mind. Let's see. I'm looking at the time.
Okay, Don's not at his top.
No, I'm not.
Fitness. He got his flu shot yesterday.
No,
or a COVID show.
and the COVID at the same time.
You
don't
couldn't get
do
the
them.
AS whatever at the same time? What's wrong with
I
you?
don't
Come on.
care what Travis Kelce says. Do not get them both together.
There's
if
a
you're
guy,
older,
no-win
do not.
situation. Dumbest man in the world, but good luck to him. So,
Travis Kelce?
yeah. 'Cause
How
once
dumb
it's-
can
once
he
it-
be?
Once it's over with Taylor Swift, he is starts
think
with
about
a
it. Well,
D and
but-
ends with a D. I mean, it's over, dude.
But
sorry.
you know, there may be something there. You never know.
All right.
Could be
Good
real.
luck.
Could be
Good
for
luck.
real.
Yeah.
855-935-TALK, 855-935-8255. We do have a couple of calls. We do have some lines open. We do have time. And we do definitely, absolutely, positively want to try and help you any way we can get this right. Because I can't say it enough. What we're really talking about is your entire future. You've got to take this more seriously than many of you do. Please call. We'll be back.
Tom and Don are talking real money.
Do me a favor. Grab your latest investment statements if you know where they are. How many do you have? A lot? How many different investments are in each statement? A bunch? Do you own individual stocks, bonds, sector funds, and stuff you don't understand? Yeah, I thought so. I'm Don McDonald, and I'm pretty sure you have a case of hodgepodgeitis. But don't worry, it's not terminal and can be cured. But it takes three things: a bit of time, some fiduciary guidance, and a plan. There's a problem, though. Most financial advisors can't or won't provide any of those. That's where we come in. Tom and I will provide you the help you need to overcome hodgepodgeitis in a free, no-obligation meeting with an Appella advisor at TalkingRealMoney.com. So, scan or take a picture of all those pages you gathered, then go to TalkingRealMoney.com, click on Meet an Advisor, and set up a free appointment online or by phone when it's convenient for you. Let us sort through the mess and help you get started on a better, simpler future plan. Just go to TalkingRealMoney.com or call 800-386-3004.
Your guides to a really great financial future. Tom and Don are talking real money.
Need a little help with your money? We're here to provide it every Saturday afternoon from noon to 2 Pacific time on Northwest News Radio in the Seattle area. Also as a podcast, most of the time 5 days a week, except coming up, we will have a few days over Thanksgiving where there will be no podcast.
Happy Thanksgiving to you all. We will not be live a week from today on Saturday either. So
no, we will not.
Enjoy your break.
855-935-8255. That is our phone number. And James, you're on. Welcome.
Hi.
Hi, James.
Calling from Port Orchard. Just wanted to correct the record about what Tom said earlier. I've been actually following Bob Brinker for many years. And back in 1999 of December, he had a 100% stock position. It was in January of 2000 he changed his stock position to 60%, 40% in cash, and that following March is when the tech-heavy NASDAQ 100 started to drop quite a bit. So just wanted to correct Tom on that.
Well, my apologies for getting his my recollection, and this was a recollection only, and it's been a couple of years, was that there, somewhere along the way his timing system, and this is why I don't like timing systems, had said buy this, and it was the exact opposite. So I apologize to Bob for that. But
I will have to say I love your show, and Bob believed in having actively managed mutual funds. I don't do that. I just love the indexing system, and I just love you guys. I love your show.
Thank you very much.
Yeah,
we really appreciate it, James. 855-935-TALK, 855-935-8255. And Jim, you're next. Welcome to the show.
Thank you. I really enjoy your show. I've been listening to it for several years. My question is, if I had invested money since January, what reasonable amount of money on a diversified account should I have received today?
I got it right in front of me. What's your stock to bond ratio? I've been waiting for this call for like 10 years. What percentage in stocks? What percentage in bonds?
75-25.
Oh, you're going to make it hard on me. Okay. All right. Hang on. I can pull that one up too. Because I have 100% globally diversified stock portfolio year to date, according to our friends at IFA.com, where you can go every day. They update that every single day, the returns. The 100% portfolio is up 7.0, which sounds pathetic when you compare it to the Standard & Poor's 500, which is up 18.7, right? And that's because some of the other stuff, the other stuff hasn't done as well. Small hasn't done as well, international large. But if you look at some of the other asset classes, international values up 11.5, emerging small. So let me just take a quick look while you're on here, Jim, to see if I can find the 80-20, or pardon me, the 75, because a 60-40 portfolio, 60% in that globally diversified portfolio of stocks, 40% in bonds, has made 5.6%. Again, that's balanced between stocks and bonds. So I'm trying to open their IFA app, which is huge. Oh, hang on. Went to 100. I mean, it's a massive.
There's a lot of buttons to push.
There are a lot of buttons to push. Mark Hebner does a wonderful job keeping people informed. They, at their portfolio, 75% in stocks, 25% in bonds, up 6.18%, and that is through the market close yesterday.
So if let's say I started with $12,118, and as of 31 October, I have $12,216, meaning I've made about $8. Would that be should I be looking for something else?
Well, it sounds like it, but I don't know because, number one, in November, prices have raced up, as we mentioned earlier in the program. Stocks are up over 7.5% this month alone. So I don't have any way to go back. I guess I could, but I don't, right off the top of my head, it'd be hard for me to go back and look and see what returns were at the end of October. I know they weren't very good, stocks or bonds. So, but this is.
But we go through lots of short periods.
That's the exact point. The question at hand to me would be, how are you invested? What things is it into? Are you in a diversified portfolio? Are you in an expensive fund? Are you in a passive portfolio? Because if it's properly positioned, looking at 10 months of returns is meaningless. It really is. The academics are going to tell you less than 10 years is meaningless, but you should put the odds in your favor. Be massively diversified. Have the right balance between stocks and bonds, and keep your costs and taxes low. So without looking at really the portfolio you're in to see if you match up with that, I couldn't give you really thorough advice.
Well,
that's what we're stuck with is rough.
I'm debating on moving more money into this fund because I believe in it, but I'd like to have seen a little bit better performance.
What fund is it?
Yeah.
I prefer not to say over the radio.
Darn it. If it's a mutual fund, nobody's going to rush into it, but I'd be dying to know because really, if you're invested the way we believe you should invest, you shouldn't be crazy about any funds because it's not the fund, it's the concept. It's the strategy.
After I come off the radio, one of you want to talk, I'll tell you what the fund is, but I don't want to say it over the radio.
All right, tell you what, when we're off the air, just go ahead and give it to our producer. He'll pick up, right,
yeah.
Zach?
He's got it. He'll do it, yeah.
He'll pick it up, and he'll send it to me and Tom.
Yeah.
All right? Because I'm dying to know. We won't say it on the air.
You.
All right, thank you very much.
Great. And by the way,
yes,
talk
sir.
more.
Talk more.
Thank you so much, Jim. That really makes the holidays better.
Here's what I'll do. I'm just going to throw it to Tom. I'm just going to say, Tom, here's 10 minutes for you. You complain about not having enough time. Here,
no, and what you just said that's the message with the most clarity you've ever delivered.
Me?
Yeah.
Really?
Because here's
as badly
what
as I'm feeling today?
I know, because here's what people end up thinking. I bought this fund and it didn't produce. Mm-hmm. And they look at it for 10 months. As Jim said, well, it hasn't made any money. That is a meaningless period of time. It means nothing until we know the actual fund, because what you just said about the type of things you own, that's what you need to know. Do you have big companies and small companies and growth and value and all this international stuff? And do you have the right balance between stocks and bonds? It's the concept, as you said, first, not the fund per se. That's the mistake people make.
You never buy a story. Don't buy a story. You want to invest from a plan, from a blueprint, from a strategy. You want to have the strategy so that your tactics can match up with that strategy. What we do is we reverse the tactics and ignore the strategy.
Bingo. Now, the tactics have changed over the years.
Yes, dramatically.
They have. I mean, and today you can buy that strategy that Don just mentioned for certainly no commissions, and you can buy it for almost nothing in terms of the management of the money, because you buy index or index-like products. Exchange traded funds. So
unlike real estate, this has become commoditized.
Exactly.
And once it becomes commoditized, the fees go way down, real estate agents.
Bingo.
Just telling you, daughter of Tom.
I'm going to get another phone call here soon.
You are.
So no, that's the point though. But and again, in any case, if you're properly invested in the way I just said, at low cost and tax efficient, it doesn't matter what 10 months of performance. Frankly, it doesn't even matter what 10 years, because you've got the concept right. Over the long haul, it has worked. We hope it will work into the future. That's the best we can give you. Really is.
Yeah, and speaking of the daughter of Tom, by the way, you could always come to work for Appella. You've already got the skill set down.
That's a good
Look
point.
at your brother. Just look at your brother. We'll be right back. Don't go away.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
Now, I want you to think about something for a minute. Tom and I have been doing this show and our podcast for a very, very, very long time. And over that time, we have always said, we're going to help everybody for free with no high-pressure sales pitch. I know that sounds like a lie because most people lie about this stuff. But think about this for a minute. We don't screen our calls. We take every call that comes through. So if somebody got a high-pressure sales pitch from one of our advisors, we would have heard about it by now. So what we'd like you to do is get the help. Go ahead. It's free. It's easy. You just go to talkingrealmoney.com, click on Meet an Advisor.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor. Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services. Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.